Meta Platforms Inc. is currently trading at $464 a share. It has had a massive boost after its fourth quarter and full year earnings of 2023 with big news about its quarterly dividend. We're going to be looking through the earnings and then taking it to my stock valuation spreadsheet to see if Meta is a buy or a sell using discounted free cash flow model, the comparable company model, and the Ben Graham formula for investing to see if this is a buy or a sell. So let's just get straight into the earnings right now. This is the fourth quarter earnings and the full year of 2023, and then the dividend, which is a big talking point. From Zuckerberg, he said, "We had a good quarter as our community and business continues to grow. We've made lots of progress in our vision for advancing AI and the metaverse." But we don't care what he says. We're here to look at the numbers. We'll look at the revenue here, up to 40 billion compared to 32 for the same time in 2022. Overall, of the last 12 months, it is 134 billion to 116, so that is up. Then we have a look at the net income. 4.6 billion up to 14, and over the year that is 23 to 39. Everything is up for Meta. Users are up, daily users, monthly active users, revenue and ads, everything here is up. And the main issue or the main talking point of the day is Meta's board of directors declares a cash dividend of 50 cents per share of the outstanding common stock A and B, payable on March 26th to shareholders of record by the close of business February 22nd. So buy your shares before then if you want to get paid. We intend to pay a cash dividend quarterly basis going forward, subject to market conditions and approval by our board of directors. So that is massive, massive news. And if we look at the stock, it has reflected that. It had a big jump post earnings, up almost 20% in that time. And Meta stock has been on a pretty crazy run. It did have its prior all-time highs back in the end of 2021 at $378, was down 76%. People said the stock is done, and since then it is up almost 400% in that time to its all-time highs. So let's go into my automated stock valuation spreadsheet. If you want to download the spreadsheet, please take a look at my Patreon. Links are in the description. But let's have a look. So what we do is we just type in Meta here, and what this will do is it will bring all the company financial details. So currently has a price of $464. 2% change, market cap of $1.2 trillion, PE of 30.33. Now, if we have a look at the market average right now, 26.87. So that is a little bit higher than the market average, but still pretty good. Earnings per share, $15. Beta of 1.15, which means it moves a little bit more volatile than the market. 2.6 billion shares, and analysts have a target price of $392. So it's currently trading above analyst estimates. On the dividend, this is a 0.42% dividend, which is about $2 a share. They pay around, or they will be paying $5 billion total, which is about 12% in terms of payout ratio and free cash flow ratio. So it is a very, very safe dividend. Just please give a like on the video if you enjoy it, subscribe, and check out Patreon, and give some comments on stocks you want to see. But let's have a look at this. We have the revenue, but let's look at the numbers over time. We have the numbers back going here to 2012. And revenue has been steadily climbing. It is up almost 134 billion in that time to all-time highs of 134 billion. So it keeps on increasing. It was down last year, but they've gone from strength to strength really here. Next, you want to look at the net income. Not its all-time highs. All-time highs were 2020. It had a big drop off in 2022, but it has gone back to 39.1 billion. So that is excellent to see. Next, you want to have a look at the shares outstanding, and actually Meta have been buying back their shares and rewarding shareholders. So why is this important? Well, if you own one share of a company and there's 10 shares, you own 10%. If they buy back 5 shares, that would only be 5 shares, and you would own more of the company because of that, so more of the company profits. So we can see that they were issuing more shares back in the day, but they have been they issued more shares up until 2017, and they've been buying back since then. So that is excellent to see. I believe actually if I go to the, I closed down the earnings. Let me just open that up. There we go. And we'll go buy shares. You can see, yep, they have a share repurchase. We repurchased 6.32 billion and 20 billion of our Class A common stock in the fourth quarter of 2023. As of December, we've had 30 billion available for authorized repurchase, and we announced a 50 billion increase in our share repurchase authorization today. So they are continuing to reward shareholders by buying back shares. So expect this chart to go down in the future. Assets versus liabilities. We can see here that the assets of Facebook were very high, and what they've done is they've managed to the liabilities have been increasing, but still nowhere near what the assets would be. So this is not necessarily a bad thing. Finally, we are going to look at the free cash flow. Why do we care about this? Well, this is cash flow from operating activities minus capital expenditures, and this can be used to allocate dividends, as we've seen, pay down debt, and continue growing the company. And we are at all-time highs with free cash flow, even more so than the good numbers back in 2021, with just shy of 44 billion in free cash flow. Now, we will have a look at our discounted free cash flow models. What this does is it's the valuation method that estimates the value of investment using its expected future cash flows, determines the value of investment today based on how much money the investment will generate in the future. So we have calculated the future revenues, we've calculated the future cash flows, and based on averages, this gives a stock price of around about $240 a share. So what I like to do is have a look at these values and see if this is expected. So in terms of revenue growth rate, you can see it's been all over the place. So we're going to have a look at what analysts are saying in terms of revenue growth rate. So if we just go to the analyst section of Yahoo Finance, they're expecting on the, we'll go on the average, 156, 176. So we will plug a sort of similar growth rate. Yeah, they're expecting pretty big growth. I'd say 14% is about what they're saying. And this brings it to a $300 stock. Next, we'll have a look at the net income margins. Net income margins are a little bit higher on Meta. We'll discount 2022. If we take an average of these, the average is actually around about 32%. So that puts it to a $322 stock. And finally, net income to free cash flow. Let's go on the high side. Let's just say it was about that 100%. Still overvalued based on discounted free cash flow model with a calculated stock price of $383 a share. Next, we'll have a look at the comparable company model. What this is a way of evaluating a stock using metrics comparing against similar companies. So the areas that we are looking at is EBITDA, which is earnings before interest, taxes, depreciation, and amortization, EV to revenue, EV to EBITDA, and PE. So the comparable companies that I have gone for are Microsoft, Apple, and Google. These are sort of the biggest tech stocks that we have. Obviously, Apple and Microsoft a little bit bigger than Meta at the minute, but Google is a fair comparison. So if we have a look at these ratios, EV to revenue, it is just about higher than the average with 9.3. EV to EBITDA, it is a little bit higher as well, but PE ratio less than Microsoft but higher than the other two. So if we take these as an average, based on EV to revenue, it's a $460 stock, EV to EBITDA 500, and PE about 470, which gives an average of 480, which currently means it's undervalued. Finally, we're having a look at the Ben Graham model for investing. Ben Graham is the father of value investing, and what this looks at is earnings per share versus growth rate companies, and expecting doing a calculation based on that. So if we have a look at the analyst estimates of Meta, what are they expecting? And over the next 5 years, they're expecting 26% growth. So we'll put that in the sheet. And then the bond yield, AAA bond yield, I think this number hasn't changed since I've done it. Oh, it's actually a little bit higher. So the stock, well, you'll see what happens with the price. 4.87. So I'll just put that in there. And you can see it does drop a little bit. Ben Graham actually would say that this stock is about fairly valued with about $443 a share. And the Graham price, which is a margin of safety, is 322. So he would say the stock is actually about fairly valued at the minute. Comparable company model does say it's a buy, but pretty much fairly valued. And discounted free cash flow model says that it is a little bit expensive. So quite interesting to see the stock is about fairly valued based on the current earnings estimates and across these methods of valuation. Right, guys, thanks for watching. Please give a like on the video if you've enjoyed it. Subscribe if you're not already, and I'll catch you guys next time.